Okay, so welcome back. We are looking at the employment data now. This is the first part of the household data that we're looking at. Um, Employment data, it really is. We are quite familiar with what employment data is. It indicates the health of a country's economy. Higher employment signals a stronger and a healthy economy. That's very, we should be thinking of this quite naturally. The more people who are working, that shows that the country is strong, shows that economy is strong. Less people working shows that economy is weak, shows that there is a problem. So as we look at higher employment, we look at employment numbers, you need to consider the total number and percentage of people who are seeking for work, who are unable to find work, the jobs being created, and also the change in dollars per hour or their wages. So why those 4 points? Seeking for work? How many people are actually looking for work? Because that actually tells you how many people are actually trying to find work, or they might have lost work before and now trying to find work, who are unable to find work, whether it is because of no jobs being created. That's point number 3. As jobs are being created, it actually shows that businesses are feeling positive about the economy as they create jobs to hire more people. Businesses are unlikely to create more jobs if they feel that the market or they feel that economy is going to be weak. And then lastly, the change in hours, dollars per hour, or the change in wages. If people are working but getting paid less than before, if the change in wages is worse than before, are you going to be happy working and getting paid less? Most definitely not, unless it gets really dire that having a job is better than having a job that pays you less is better than having no job. So that change in dollars per hour or that change in wages is a signal of inflation, is a signal of the likelihood that businesses are paying more, as a signal of the overall health of the economy. So all of these employment data comes into play to actually tells you what could happen, or actually tells you what the movements of prices could be. But remember, this is right at the bottom of the pyramid. This is probably going to have some impact, but not very long-term impacts in the overall scheme of things. Employment data is also considered to be a lagging data. Why I say that? It actually indicates the economic situation of the previous month. It takes time to actually collate employment data, and it's actually reported the month after that. They don't tell you how many people are going to be employed. They actually tell you how many people were employed last month. So it gives you a view of what happened last month. But we should always have the view that companies do not hire for the short term. If companies are to hire, they are probably going to be more confident of economic stability and the overall future of the market. That's why companies put up opportunities to hire. And although it tells you hiring processes last month, it actually gives you a view of where the market could be heading into the short, medium, and possibly longer term future. One thing you also want to consider when you're looking at employment data is that sometimes they could be affected by external factors. So it's not always economic factors that affect employment data. External factors such as terrible weather, labor strikes, government policy, short-term government policy could affect employment data in the short term. So putting all that together, you want to actually have a broad overview of the market rather than over focusing on small changes in data. You want to look at the overall view of how the market is going to be, the overall view of economics. Employment data applies to several currency pairs. One thing you have to look at is employment data is actually classified differently in different economies. For the Aussie, there's the AUD. It's called the employment change, which is being released monthly, and the unemployment rate, which is being released monthly. Employment change actually tells you the change in employment, which is how many more people are being employed on a month-to-month basis. The unemployment rate tells you how many people are unable to find work on a month-to-month basis in terms of a percentage. New Zealand is similar to the New Zealand dollar, or the New Zealand economy is similar to the Aussie, where employment change tells you the number of people who are being employed on a month-to-month number, the extra number of people being employed on a month-to-month number, and the unemployment rate is going to tell you how many people are unable to find work on a month-to-month based on a percentage. These two are quite similar. Same with the Canadian dollar. Employment change telling you how many people are being employed. Unemployment tells you the percentage of people who are unable to find work. For the UK, that's the British pound, it is going to be slightly different. The UK gives out or releases a claimant count change number. Claimant count change actually tells you not the number of people who are being employed for the month. It actually tells you the people who are claiming for unemployment benefits on a month-to-month number. So obviously, if a claimant count number, which is the number of people claiming for unemployment benefits, increases, that actually shows that there's less people working because more people are claiming for unemployment benefits. But for unemployment rate, it is going to be the same across the board. Same in the UK with Australia, New Zealand, and Canada, where we look at the unemployment rate, which is people who are unable to find work for the month. It also applies to the US, but the US, unlike the other pairs or the other economies, we are looking at 3 employment data coming from the US. Unemployment claims released weekly on a Thursday. So we'll take note of this. Unemployment claims from the US, again, data signifying or data indicating the number of people unable to find work, claiming for unemployment benefits. But this is a weekly number. What you want to take note of is being a weekly number is going to have a smaller impact than data being released monthly, because you need 4 weekly numbers to result in a monthly number. You're going to expect smaller changes in price with that weekly data being released. Non-farm employment change is a monthly number coming from the US. That's the first Friday of every month. That's the first Friday of every month where the non-farm employment change number is going to be released. And the unemployment rate, which is also released monthly, together with the non-farm employment change number released on the first Friday of every month. What you'll notice here, okay, take a note of this. I hope you're writing this down. What you'll notice here is that we have ignored some other currencies, such as the Japanese yen or the Japanese economy. We have also ignored the euro. These employment numbers, they do release employment data, they do release employment numbers. However, these have not given much economic or much price influence or much significant price changes when these numbers are being released. So because of this, I actually would recommend that you focus, coming back to this, you focus on employment numbers only for the Aussie, focus on employment numbers only from New Zealand, the UK, Canada, and the US. It doesn't apply to, or it applies less to the point where I would even not recommend looking at it to the Japanese yen, to the euro, or even the Swiss franc. Keep it to the 5. Let's keep it very simple. One of the main things you're going to focus on is the non-farm employment change number. This happens on the first Friday of every month. First Friday of every month. It represents the total number of paid workers in the US. It is a very high, very volatile news event. Why is this so? It's because It's not just Forex traders who look at these non-farm employment numbers. Stocks, equities, futures, options, anyone participating in the financial markets will look towards these non-farm employment change numbers from the US. This gives a very good indication of how the US economy is doing. As the title says, non-farm employment change, it captures employment data outside of the farming industry, because the farming industry is going to be impacted by seasons, it's going to be impacted by different schedules. It has many external factors outside of the non-farm, outside of the farming industry. This gives a very good representation of how the US is going, how the US economy is performing. This happens on Friday, the first Friday of the month. At that same time where the non-farm employment data is being released, unemployment rate from the US is also being released, and the average hourly earnings for the US is also being released. So it usually happens at about 8:30, depending on daylight savings, 8:30 GMT plus 8, 8:30 Singapore time, GMT plus 8, you would see non-farm employment change numbers, unemployment rate, and the average hourly earnings coming from the US. These are three very high impact, very high volatility news being released at the same time. What usually happens is at this time, you will see a lot of volatility. You see pretty much across the board, all prices will be moving significantly as this news is being released. At this point, I want to take a short side note and tell you that the first Friday of the month of October is next Friday. Not this Friday, not tomorrow, next Friday. So I want to actually do a live non-farm trading or non-farm employment change trading session. This will be held live. I will be trading a live account. I will be guiding you through how to trade these non-farm employment change numbers together with the unemployment rate, together with the average hourly earnings. I hope that you will sign up, you will join this session. Should we do it for Traders Club only, or is it going to be live for everyone? The guys have told me it is going to be only for Traders Club, so make sure you sign up for Traders Club. Traders Club members, we will be doing this on Zoom. As much as we can, we only have a limited of 100 seats on Zoom. Okay, Zoom, I can't go more than 100. I don't want to subscribe for more than 100 seats. So only for the first 100 people who registers for this live event will be attending. You can choose during this session to copy my trades. You can choose during this session to just sit and watch. You can choose during this session to go completely against what I do. So long as you are there, so long as you're present, it will be live on Zoom. The link will be up shortly. It will be in Traders Club. Make sure you join Traders Club. Okay, but now with that side note, we're coming back to the main event. Employment data is going to be crucial to every news that comes out, because employment data comes out across all different currency pairs over and over and over again every month. These do have a short to medium term impact. You know which currency pairs to pay attention to, but it is only step one, number one of all the economic news. If you have any questions, please feel free to put it into the chat or into the comments. The next one we'll look at is consumer sentiment. Consumer sentiment is a survey conducted by the University of Michigan in the US. Consumer sentiment is a leading economic indicator. It tells you of the household's confidence regarding their stability of income. Think about this. If your income was stable, or given that your income is stable, you would be looking to spend more. You'll be happy to spend more. could lead to potential increases in consumer spending. This is why consumer sentiment is really important, because as consumer spending makes up 2/3 of GDP, remember where GDP is? Quite high up onto the pyramids, 2/3 of GDP. This survey, this consumer sentiment actually indicates, can give you a slight indication of where the economy is likely to head. For the University of Michigan Consumer Sentiment Survey, this only applies to the US. I do not look at consumer sentiment across the other currency pairs. I only look at it for the USD because, as I shared with you the last session, everything, if there's a consumer sentiment increase or if consumers are feeling more confident, especially consumers in the US, this could lead to an overall global increase in confidence. If everyone in the US is thinking that income stability is weak, they stop spending. One of the biggest global economies stop spending or spend less. A drop in GDP from the US is likely to result in an overall global drop in spending over global drop in GDP as well. So consumer sentiment, you see it, it's the University of Michigan Consumer Sentiment. It's an indication of, it's an economic indicator of stability of income and consumer spending.